And 72% of the time the market goes up. And the answer came to me. And that's what I developed my chart. The answer came to me is because, just like Caterpillar, when they pull their money out, you get out. Whoa.
It's your daily dose of how to manage your money. And now it's time for Phil's Gang on the Off the Wall Street Network.
Oh, God. Are you nuts?
With your host, Phil Grande.
Bye. Thank you for joining me today on my podcast. Well, we're coming up on the holiday, so that means that most of the big boys who make the market work, they're called market makers, the big money, they're gone now. So you got to be very careful between now and the end of tomorrow, okay? Because as the volume gets lighter, things look better than they actually are. Talking about things looking better than they actually are, it's amazing what's going on. You know, every time that I hear these jibber jabbers on TV, these financial jibber jabbers on all these financial shows, they're always taking some fundamentals, I always tell you, and try to make a story out. They create a story out of it. And you can't listen to the fundamentals. Today was a perfect example of what was happening today in the market. I mean, I tell my gang members every day, look, don't listen to these jibber jabbers on TV, okay, that they give you bad information. And all these fundamentals they talk about all the time, okay, so they can create a story, they're worthless. You've got to follow the money. If you follow the money trend, you'll be just fine. And two things you need to do to make money in this business. Shut the TVs off. Don't listen to the jibber jabbers. Follow the money. Learn how to follow the money. It's a really easy business. It's all about trend. Is the money trending? Is it trending in or is it trending out? All the stuff they put around it, all the frills, is all BS. It's all to make it complicated for you, so you need their help. One of the funniest things about this industry is that they always screw the retail investor. For example, why trading is so easy, because all you got to do is follow the money. If money goes into a stock, it will go up. If money comes out of the stock, it will go down. And all you got to do is follow the money. Who? The big institutional money. They always leave a footprint behind. You know exactly when they're buying, exactly when they're selling. It's not hard, especially if you have the right charts. So, but every day they come out with these crazy stories. So, for example, today, they're rotating out of tech and they're going into economy stocks like banks. But if you go look at the yield curve, they're not supposed to be doing that. So if you listen to the jibber jabbers today, and they'll start talking about the yield curve and how it's flattening, it's tightening, right? And they're telling you to do exactly the opposite of what you should be doing. So today we got people in the market, they're getting out of tech stocks and they're pushing money into the bank stocks. Well, when you have a yield curve that's tightening, that's really bad for banks. So why are you doing that? So again, once you learn how to follow the money, you'll be just fine. But you also got to learn how to sell short. Going back to what I wanted to mention about how they screwed the retail investor. Think about it. Before we had discount brokerage, brokers on Wall Street were making, in today's dollars, $100 to $300 a pop. And they used to really work hard for you. They would go and try to find these undervalued companies, really work hard to find them, do a lot of work, a lot of research on them, but you don't get research anymore unless you have $5 million in an account. I'm being serious about that. You don't get research. And they would really work hard. When the discount brokers came in, they weren't making $100 to $200 a pop anymore. They're making $5 to $15. So what's the first thing they said? well, we got to do something else. So the first thing they did is they decided, why don't we buy the stocks first? We'll mark them up to our clients. They won't know the difference. Well, that's pretty stupid, because that's like going to Brooks Brothers and buying a suit for $500 off the rack. Then you can go in front of the store and you can sell it for $1,000, right? That's pretty stupid. It didn't work. So now they said, okay, well, then let's forget the retail investor. Why don't we start managing the $50 trillion that's out there in money that that has to be managed. That's money coming from 401ks, IRAs, millions and millions of savers. It's one big pool, a big lake, right, of money. Why don't we manage those? But the problem is, if you go look at Enron as a great example, they had to make sure that the small investor, the retail investor, would never short a stock. Because why? Well, if you look at Enron itself, you notice how when Enron went up, money is going in. When money's coming out, Enron's supposed to go down. But what do? They told the retail investors, okay, they had to take parking space in their head that shorting was dangerous, terrible thing, you shouldn't do it. And when stocks are going down, if you're smart, you're going to cost average down. You're going to cost average down. If you like the stock at 90, you're going to love it at 30. This is what they did. And so the retail customer, when stocks started to go down, like Enron, what were they doing? They were in there buying more shares, cost averaging down, and buying on the dip when there was no QE. You never buy on dips when there's no QE, because you get crushed. QE, remember, was from 2008 to 2012, and QE was designed to push stocks up. And so when we have, every time in 2008 we started to rally, every time the market pulled back, and it kept pulling back several times, they'd go right in and push it right back up. So the Feds would. So that's a perfect time to keep buying stocks when on pullbacks or on dips. You always buy on dips. As long as the trend's going up, you buy on those dips. It's a perfect time to buy on dip, but you don't do that unless you have QE, because you have no guarantee it's going to go up. So going back to what they did, they convinced the retail investor never to short a stock. Instead of shorting, keep buying. And they even took the ratings that used to be sell on the way down on a stock. No more. Very few times you ever see a sell. So it's always buy, right? So my point is, they had to take parking space in the retail investor's head, so they would go in and keep buying these stocks like Enron when they're coming down, to hold the stock up so they could get everybody out. So the point is, they don't care about you, not at all. So that's why retail investors, 85% of you, lose money. You never cost average down, okay? You never buy stocks on the way down in a trend. That's ridiculous. You short, but people are scared to short. But going to my point, that's what these people do on Wall Street. So like today, we're seeing they're taking money now. They're telling people to go buy these stocks, these bank stocks, which is ridiculous. You don't go buy bank stocks when you got a tightening yield curve or a flattening yield curve. Banks, that's bad for banks. But again, talking about how they just don't care, it's the same thing. I'm listening to all these people, these traders, right? These geniuses that are on TV, and I listen to them. I mean, it's just good entertainment. It really is. And how many times? I mean, they keep telling you, okay, everything's always a buy, right? So today is a perfect example. The story today is rotation. The story today is, let's take money out of tech and put it into economy stocks, including banks. That's stupid, because I said 10 times already that we have a tightening yield curve. Now, so the opposite of that you should be doing, just the exact opposite, but they're not going to tell you that, correct? No. So again, the most important thing you got to keep watching is the 10-year and the 2-year. The problem with the 10-year yield and the 2-year yield, they're still too high. So it's screwing things up, okay? You can't be buying these stocks when you have the 10-year keep rising and the 2-year keep rising. You got to get that 2-year below 4%. Okay, so whether you're buying bank stocks or tech stocks, the biggest problem we have in our market right now is you got to get that 10-year treasury down, but you need to get that 2-year yield below 4%, or you're screwed. You got to get that below 4%. So, and now we got the 10-year is going up faster than the 2-year. Now normally that's good for tech and bad for banks, right? So the 10-year is rising faster than the 2-year. And as I said, if you know how to trade, you know already when you see that that's good for tech and bad for banks. But what are they doing today? Even though the 10-year is rising faster than 2-year, they're telling everybody to go and buy, go and get rid of your tech stocks and buy banks. Just the opposite way you should be doing. So and the other thing we're seeing today too is everybody jumping at these like energy stocks, right? The easiest place to make money in the stock market is all you have to do is, if you think about it, when oil prices go down, when oil prices go up, you can make a lot of money buying oil service stocks. Because when Exxon or Chevron finds oil, they call in Schlumberger or Baker, okay, and they'll go do the drilling. They provide the crews, they provide the rigs, they provide everything, and so they'll provide all of that. And so again, when it's so easy, if you just stop following the fundamentals and follow the money. So when you got oil that is going up, and you look at Exxon for a stock to buy it, but the stock is going down, forget that. Now, this is what Wall Street won't tell you. If Exxon's oil stock, that price of that stock's going down, okay, but oil is going up, go buy the service stocks, because Enron is going to tell an order from Schlumberger or Baker, all kinds of rigs, all kinds of crews, all kinds of equipment to go get that oil out of the ground. So if you think about it, if you just follow the money, oil prices going up, then go and buy the oil services. Now, if oil prices are going up, what else do? You short the airlines. Because when oil prices go up, jet fuel goes up. Now, this is just easy stuff. It's common sense stuff. But Wall Street's not going to tell you to do that. They're not going to tell you. I mean, people have made a fortune in two areas. In the oil service stocks and the airline stocks. You just do the opposite. So if oil is going crazy, the price of oil is going up, you short the airlines, but you buy the oil services. When oil prices start going down, it's just the opposite. When oil prices start going down, you start shorting the oil services and you buy the airlines. There's people on Wall Street that make a fortune just trading those two sectors, watching oil. So my whole point is, trading doesn't have to be as complicated as everybody makes, especially with all those stupid, those Japanese symbols, like dojis. They got all these different names, the twist and the flying tail and all this. They put all that in there to confuse you, so you're going to have to seek help from Wall Street. There's only about 5 signals that you need. I'm running out of time, but there's only about 5 signals that tells you when to buy, when to sell, and there's easy patterns that tell you if money's going into your stock and money is coming out. You don't have to listen to Wall Street. You don't have to listen to the jibber jabbers. They're not on your side. If you always remember, stocks always do what they're supposed to do, but never when they're supposed to do it. So what do? If you follow the money and the trend, you will never be wrong. And just as I'm finishing up here, the other thing that drives me crazy is that people have no idea that this stock market is in such danger, but they can hold this market up for years as long as they keep that pool of money, that lake of money, that $50 trillion that's being, think about this $50 trillion, right? That money is all from 401ks, IRAs, and then who manages all that money? You got, it's all, by JP Morgan, Goldman Sachs, hedge funds, Vanguard. So this lake of money is, and even during, the crashes, in 25 years, the 5 crashes we had, 2008, 2011, 18, 20, 22, those 5 years, do you know that pool always had about $50 trillion in it? Always had about 50 trillion in it. And so the thing is, again, talking about following the money, every time when you get a crash, it's because that pool of money, if you're going to try to buy, let's say, tech stocks, there's a pipe going out of that lake that will buy tech stocks. The pipe going out of that money lake that will buy housing stocks or health insurance stocks, whatever you want to buy. There's pipes. Think of always as pipes coming out of this lake that has $50 trillion in it. When interest rates start to keep climbing, those pipelines, when the big institutions want to buy tech stocks, let's say they want to buy this chips, well, all of a sudden they can't buy the chips because that pipeline is plugged up that goes to the chips, from the lake to the chips. How's it get plugged up? Because yields keep going up. And every time you got these yields going, that's why you only have a handful of stocks holding up 700 stocks. So when you have that pipeline, you can't get money from the 50 trillion to tech stocks. You can't get money from 50 trillion. You can't get the money to healthcare stocks you want to be. It's because yields keep going up. Why is that? Because we're spending on a daily basis $5 billion more than we're taking in. And on a yearly basis, our deficits are about $2 trillion. So that hurts the stock market, because when you're running massive deficits like this, okay, that means we're spending more than we're taking in. And what they have to do every day is to keep selling. They have to borrow money. They have to keep selling treasuries. They have to keep selling T-bills. Because at the end of today, they're going to be short $5 billion. They got to cover it. So they keep selling stocks, keep selling treasuries. So what happens if you're selling 5 billion treasuries a day? We don't have the money. We got to sell it. We got to raise it. So what happens to that? The yields keep going up. So when you're trading today and you see the yields going up, and you wonder why your stock's not going up, your tech stock's not going up, it's because yields are going up. And who's causing the yields to go up? Congress. Why? Because they're spending $5 billion a day more than they take in. So if they keep spending $5 billion a day more than they take in, they have to borrow the money. They do that by selling treasuries. And the more treasuries they keep selling to cover that deficit every day, yields go up. So when you're sitting there with your tech stock, and remember, tech stocks like low yields. So when all of a sudden your yields are going up because of Congress, they keep spending too much money, and the yields go, your tech stocks all of a sudden not going up anymore. So what's happening today? People are pulling their money out of tech stocks and they're shoving it into industrial stocks, into economy stocks. And my whole point is that trading is not hard. You can make a lot of money trading, only if you follow the money and you follow the bond market. If you don't know how to follow the money, you don't know how to follow the bond market, you're in the wrong business. You shouldn't be in this business. You shouldn't be trading. And the problem is 85% of the traders are dependent upon turning on TV and listening to these dopes. And I mean, they sit there with a pad and write down every stock they're talking about. What's the hot stock today? There's no such thing as a hot stock, because the bond market changes everything every day. And why does the bond market change everything? Well, first of all, the bond market will tell you when the market's going to crash. The bond market tells you when the stocks are going to go up. And what drives that? Yields. And what drives yields? The deficits. If we have low deficits, we don't have to keep raising capital every day. We don't have to keep selling bonds every day. And we can have a nice steady market. But as we keep every day 5.2 billion a day. We don't have it. We don't have savings. We have to borrow it. We have to do that by selling treasuries. And that's putting this market in a real dangerous position because, again, I got to go here, but always remember, if you follow the bond market, it's easy to do. You follow the money, which is so easy to do, especially if you have the right charting. Follow the money. You're always going to be on the right side of a trade, but you've got to know how to sell short as well as going long. And as long as you watch the bond market, and you know every time they're selling bonds because they have to raise money, you're going to be following the bond market, going to be following the money, and then the stocks that you're trading, you're always going to be on the right side of the stock. But if you don't know how to follow the bond market, you don't know how to follow the money, you don't know how to follow the money trend, and you're listening to these idiots on CNBC and Fox Business and all them, you never can make any money. And that's why it's not me saying it. 85% of retail investors lose money. And it makes me angry because they're killing the middle class trader. The person who used to make $65,000 a year, he could trade. But that whole group's gone. Traders are gone. This is becoming nothing more than a business for very, very wealthy people. The people who used to, husband and wife, they could make nice money in the stock market. If they're making $65, $75 together a year, 65, 75,000, beautiful. They could trade, and as long as you had some decent stocks. But the problem is, stocks that are trading now for $500, $600, those stocks used to be $85. Those stocks used to be $125. You could buy a lot of stocks under $25. Those days are gone. Why? Because the deficits. Because more our government spends and takes in, the more money they got to borrow, the more money when they sell treasuries to borrow money, yields go up. And yields are going up and up and up. And take a look at your 2-year. I'll end with this. You want to know when the market's going to crash? When the 2-year, 3-year treasury yield goes underneath the 2-year treasury yield. You better put a helmet on because that's when the market's going to crash. But if you know how to short, you're going to make a fortune. If you know how to short, know how to go long, and you know how to follow the money, then you can't be in a better business. You just can't be because it's easy. Trading's not hard, but Wall Street makes it hard. Okay, that's it for today. I got that off my chest. I don't know if you enjoyed it or not. But do subscribe, and I will see you tomorrow, same place, same time. Join my gang. It's free for 10 days. Check us out, philsgang.com. Thank you for joining me today.